Everyone is lying to you about the state of the housing market. It isn't stable, it isn't predictable, and it isn't strong right now. And we're getting leaked reports from extremely important economists and officials and data from home builders and other industry insiders, which is proving that the next housing crash is already on its way. And in this video, I want to break down everything for you and explain exactly what's going on and why this is so important, and it will impact everyone, regardless of whether or not you own a house or where you might be, in the United States or in another country as well. Now, the first really important thing that we've just had exposed comes from Moody's chief economist. Yes, that Moody's, the financial analyst company with 50,000 employees around the world. And he's saying that the housing market is falling and it's bringing the US economy down with it. So here's exactly what he had to say. I sent off a yellow flare on the housing market in a post a couple of weeks ago, but now I think a red flare is more appropriate. Home sales, home building, and even house prices are set to slump unless mortgage rates decline materially from their current near 7% soon. That, however, seems unlikely. Home sales are already uber depressed, but home builders providing rate buydowns have been propping sales up. They are giving up. It's simply too expensive. A big tell is that many builders are delaying their land purchases from the land banks. New home sales, starts, and completions will soon fall. Home price has held up well, but this too is changing as prices have gone sideways and are set to fall. 7% interest rates, that is hammering demand, and there are more listings. Given their demographic and job situations, locked-in homeowners must move. They can only work around these needs for so long. Housing will thus soon be a full-blown headwind to broader economic growth, adding to the growing list of reasons to be worried about the economy's prospects later this year and early next. So over the last few years, that slow but steady increase in housing prices has already pretty much stopped, and many states are now seeing outright corrections, and I'll go into more detail and tell you what some of the specific states are doing later on. But Mark Zandi here basically states that mortgage rates as high as 7%, that is strangling the market. And it's also a little bit unlikely that mortgage rates are going to fall drastically. After all, it's been about a year since the Fed first went out and cut interest rates by 1 full percent, and interest rates on mortgages haven't fallen by an equivalent 1% over that same time period, because the Fed doesn't directly control mortgage rates, the market does. They just have little levers of influence. On top of that, according to Mark Zandi here, the job situation across the United States is shaky. We are seeing mass layoffs in a number of different industries, and a housing crash is likely to make the US economy far weaker and maybe cause it to even fall into a recession. And this is not coming from some random guy. This is Moody's chief economist, a man who is incredibly well versed when it comes to macroeconomics and the housing market in particular. Now, the next really important person to listen to is going to be the US Director of Federal Housing, who's also sounding the alarm for the housing market, and he put out this very specific tweet here. It's so totally reckless to keep rates where they are at. Mortgage rates were 3% and went to 7%. This is crazy. This crushed affordability. Inflation is down. Mortgage rates and interest rates need to come down. Jerome Powell is doing a great injustice to this country. Now, the statement here is really simple, right? Mortgage rates more than doubling over the course of just a few years killed housing affordability, and that is without a doubt categorically correct. Now, Polte here, he wants rates slashed to increase affordability and to stop the housing bubble that we're currently seeing over the last few years from popping. This is also exactly the same position that Trump has. This guy's role is actually very political, and it is being used to charge Trump's rhetoric as well. But he does also have a hell of a lot of experience with housing. Polte was on the board of one of the biggest home builders in America for years, and he's worked in this industry for decades. And he does have sort of a point here that inflation is relatively low. Yes, there have been small increases in inflation across the United States over the last few months, but it isn't yet a clear trend. And so maybe it wouldn't be an awful idea to cut rates, but there are, of course, huge fears of very persistent inflation after the last 5 years. So Powell and the Fed are being very cautious, and we'll get into that in a little bit more detail in a moment as well. But first of all, I'd like us to take a look at another clear indicator here, and this is the fact that we are seeing record level home builder inventories across the United States. Now, this graph here is for inventories for new home builders over the entirety of the United States, and we see a massive peak here in 2006, right before the last housing crisis of 572,000 homes vacant, waiting to be sold by home builders. at one point in the United States. Right now, we are seeing close to record levels, the second highest we've ever seen, of 511,000. And if we take a look at this over just the southern United States, we are actually already past the peak that we saw prior to the global financial crisis and the housing crisis back then of 291,000. We're already sitting at more than 300,000. Now again, the last time it was this bad was just in 2006, right before the global financial crisis and that massive housing collapse that went with it. And what we're now seeing as a result of all of this inventory from home builders stacking up all over the country is home builders offering massive discounts on homes, and even doing things like providing special loans with mortgages where their interest rates are far below market rates. Now, this housing inventory from new build is a really strong indicator for weak housing demand, and in particular for excess supply, which of course, if you have too much supply, that will force prices down. Builders are currently sitting on over 500,000 fully built, ready to move in homes that are unsold across the United States. Builders are also notoriously heavily using debt, and their interest payments are far higher than they have been in well over a decade at this point. So they really have to sell these homes, and they're desperate to get rid of them and to bank their profit so they don't continue to lose money on these loans that they have. That leads to massive price cuts, sometimes as much as 25 to 30% of the initial list price of a home, and builders out there offering those special mortgages with low interest rates, basically offering a discount to the monthly payments instead of a discount on the full price of the home that is purchased. Now, this is really important for one clear reason. It means there is too much supply in the market and in the economy, and that will force prices down. It means that it's turning into a buyer's market, meaning you can get a discount when you're looking to move into a new home, and that again forces prices down. Home builder inventory is a brilliant indicator for a housing market crash, as we see the highest home builder inventory in the history of the United States 1 year before the biggest financial crisis and housing market crisis again in the history of the United States. Now, the market is usually, the housing market that is, very slow. If we think about, okay, who's going to be going through that sales process of selling their home, well, they're going to think about it first of all, and then they're going to check around and look at the prices, and then they're going to look at where they might want to move, and then they're going to have to find realtors and then list their home, then actually get offers and wait in escrow, and then maybe that deal falls apart and they have to start all over again. A standard sales cycle for buying or selling a home or moving can be as long as 1 year. So prices move very slowly, and we see very few instant sales. iBuyers are still a massive minority in the United States and all over the world really, but home builders get 10 times more information than an individual, and so they adjust to market realities far quicker than an individual might. If you take a home builder who's maybe building 400 homes at the moment, or they've got one big development of 400 homes, they're not going to do it all at once. They're likely to do it in stages. So they'll have 100 homes that are planned, they'll have 100 that are currently being built, 100 that are built and currently being sold, and then 100 that are already sold. And so these home builders, they have data from every part of the cycle always, and they're always going to have a better idea of what's going on compared to normal people. But even builders can be slow to react, and it can still take years and years to run a full development cycle. And by the time that all of those homes are actually finished, well, the economy could be in a recession and there's no buyers, as it might have been a 5-year process. Or maybe interest rates have risen and affordability has crashed, and so there's no buyers, and so prices fall. And that's exactly what's happening here. These builders have been building a heck of a lot of homes for a long time, and suddenly there isn't the demand to buy them anymore, which is forcing prices down. Now, this graph here actually shows how many home builders are building homes at any one point. In particular, it measures housing starts, so when the foundation for a new home is first laid, and you can see that it is a little bit volatile as economic cycles and swings go through. We see a slow but gradual increase in the pace and the rate of growth in the housing market all the way up to 2006, followed by a massive crash, as you would expect when housing prices decrease massively, and then another steady rise. What we have seen that's a little bit strange over the last couple of years is we haven't gotten to that point of a bubble followed by a short, sharp crash. Instead, we got to the point of a bubble, followed by a slow reduction, as there hasn't yet been that crash in house prices. But that drop so far has been substantial. There's been a 30% drop in new homes being built today compared to 3 years ago, and yet home builder inventory is still huge and at all-time highs. That's just how low demand is right now. Those new homes, they're just not being sold, and no one wants to buy them or can even afford to buy them at these current prices with current interest rates. So all signs are pointing to the housing market in the United States in basically a state of limbo before a crash, right? Home builders are massively dropping the quantity of homes that are being built because their inventory is at all-time highs and they're just struggling to sell what they've already created in the past. As a result, they're giving away massive discounts and very weird special mortgage rates to try and get this inventory to move, which is already having a downwards impact on housing prices across the United States. The US Director of Federal Housing is currently sounding the alarm, stating that the housing market is basically on the brink of collapse, and if it's not careful, it's going to crash, and we need an immediate mortgage rate cut to prevent a crash. And then we have the most senior economist at Moody's, one of the largest analyst companies in the world. I think they have almost 60,000 employees now. They're saying that the housing market is at the beginning of its crash, and it might just take the entire American economy down with it, just like we saw with the global financial crisis over a decade ago now. Now, what about some specific areas though? Well, let's take a look at some specific states. Florida has seen its house prices fall by 4.7% over the last year. Texas, that's been a 2.3% fall over the last year. California, a 1.2% fall. Colorado, a 1.8% fall. And Georgia, a 2% fall over the last year. Now, none of that there is inflation adjusted at all. Those are standard figures, and we're currently sitting at 2.7% year over year inflation in the United States. So Florida's 4.7% is actually a 7.4% reduction. Texas has actually seen a 5% reduction. California, a 3.9%, Colorado, a 4.5%, and Georgia, a 4.7% as well. And even when we look at those states where actually their house prices are still going up in nominal terms, places like Kansas where, they've had 2.5% growth in house prices over the last year, well, we need to remember there's 2.7% of inflation as well. So that 2.5% in growth is actually negative 0.2% in real terms. New Mexico, prices have risen by 1.8%. That's negative 0.9% in real terms. Nevada, up 1%. Again, that's negative 1.7% in real terms. What we're seeing here, the evidence is just irrefutable at this point. House prices in the States are already falling, and there is a lot of delusion out there saying, where is the crash that everyone's talking about? But the reality is that house prices move very slowly. Even the global financial crisis, with the biggest housing market crash in the history of the world, even that saw 6 years for house prices to finally bottom up, to go from their peak when the crash started to their trough right at the bottom. That was 6 years of slow and steady house prices reductions, day after day, week after week, month after month. This is a very, very slow process, but it has, without a doubt, already started. Now, as we've just heard a bunch of people talk about, it seems that cutting interest rates might be the only way out of a crash here, but there's still a hell of a lot of uncertainty around interest rate cuts, in particular because the Federal Reserve and Jerome Powell have been very resistant to interest rate cuts. They've already cut rates, let's not forget, from 5.5% here, right back in early 2024, down to 4.5% as of early 2025. But that did not see a comparative reduction in average mortgage rates across the United States, because again, you don't just take the federal funds rate and that's what your mortgage is. That's essentially the baseline that borrowing is made at, and mortgages are allowed to make a profit on top of that. So it's determined by market rates on top of the federal funds rate. So first of all, there is no proof or certainty with saying that if we cut interest rates by another 0.5% or 1%, that is categorically going to drop mortgage rates as well and save this housing crash and turn it into another steady growth of a bubble. It just doesn't work like that. And we also need to keep in mind that the vast majority of the values of the homes in the States, that was developed and evolved, and that valuation came to terms over a decade-long period where interest rates were sat at 0.25% and mortgage rates were at 2 to 3% before that inflation crisis post-COVID. So even if we do see interest rate cuts down to 3.5% or even 3%, for example, that cost, the cost of home ownership, of mortgages, of buying a home, is still going to be literally twice as high as it would have been just a few years earlier. Now, the other really important thing here is that inflation is still actually a problem in the United States. A lot of people have sort of gaslit or confused themselves and just convinced themselves that, okay, inflation is no longer a problem, but inflation is still high. You can see here, we haven't had a single month in the States over the last year of inflation at or below the 2% target. Every single month, inflation has been higher than that, with a slight increase in recent months, from 2.3% in April all the way up to the 2.7% rate that we're seeing right now. And a lot of economists out there, in particular the Federal Reserve and Jerome Powell, they are very, very firm in their belief that actually Trump's tariffs, they think, are going to have very large inflationary effects. It's going to increase the cost of goods across the United States, and that's going to be factored into inflation. And so they are terrified, quite frankly, of cutting interest rates and stoking inflation even more. And then when the tariffs come into full force, and the markets have taken fact of that and they've adjusted their prices, then we see that tariff inflation even higher, causing another massive inflation crisis like the one we saw just a couple of years ago. And in fairness, I have to say I fully understand why the Fed is so cautious about that, because all we have to do to see what happens when you have an irresponsible government in power is take a look at the United Kingdom right now and our inflation rate over the last year. 1 year ago, inflation in the United Kingdom was 2.2%, its year-over-year figure. August, 2.2%. September, 1.7%. A lovely, lovely number to see. And it was around about this time, it was about 1 year ago, that our new socialist government came into power and started basically wrecking things. And you can see a very, very clear trend upwards in inflation across the United Kingdom, peaking now at 3.8%. I say peaking, that's peaking for where we're currently at. It is going to go higher than that, believe me. Now again, this actually is not because of bad monetary policy. So it isn't the Bank of England, our equivalent of the Fed, that has caused this problem. It is because of bad government policy. Our government has borrowed £51 billion extra just to spend for the hell of it. They have raised taxes on businesses employing people. It is now more expensive to employ a person as a business in the United Kingdom. That has forced costs up in all sorts of industries, and the government has failed to cut any spending whatsoever. So they've essentially stimulated demand artificially to a massive degree, and that's caused inflation to go up by almost 50%. Actually, more than 50%, 1.7 to 3.8 is almost 100% increase over just 1 year of this new government. So I do understand why Powell is so cautious about this in the United States. No one is really sure what's going to happen with tariffs and how much of an inflationary effect that is going to have, but it's fair enough that Powell and the Federal Reserve are cautious about slashing interest rates right now. Does that mean interest rate cuts aren't going to come and they're not going to save the housing market? Well, actually, interest rate cuts are looking more likely day by day. Obviously, the US Director of Federal Housing is pushing massively for interest rate cuts. Trump has been pushing for interest rate cuts ever since he came into power, and even before then, actually. Trump is now attacking the Federal Reserve on political fronts as well as on their monetary policy, right? He's attacking Powell and the overspending on the Fed's renovation. I think that's a purely political move. I don't think it's really about the money. I think it's about turning public opinion against Jerome Powell and against the institution of the Federal Reserve to make it more politically tenable for Powell to be sent away and replaced with someone more amenable to Trump's wishes. We're also now seeing Trump and many other Republicans and many people in general in the States calling for the governor, Lisa Cook, the Federal Reserve Governor Lisa Cook, to resign for what basically amounts to alleged mortgage fraud, as then she could be replaced by someone else who supports rate cuts and actually gets those interest rate cuts done. I do think we are going to see slow, steady interest rate cuts over the next 6 months or so, partially to placate Trump, but morely just because the economy is just a tad sluggish and inflation isn't very high as well. But we should not at all be expecting massive, massive rate cuts down to 0.25% federal funds rate again anytime soon. Will those small interest rate cuts be enough to stop a housing crash? Well, at the end of the day here, we have one huge fundamental problem, which is a massively overvalued housing market across the entire United States. Home prices have been rising far faster than incomes or wealth for years now. And so the ratio between how much you earn and how much a house costs has been getting larger and more untenable. And the only way to sustain that ultimately is with looser borrowing for mortgages. Either you allow people to have longer terms to bring monthly payments down, or lower interest rates again to bring monthly payments down, or maybe government assistance to bring deposits down to make it more affordable to buy homes. This basically allows people to keep buying, but it also continues that cycle of overvaluation, and it's just kicking the can down the road to be picked up later. Now, the ultimate problem here, and the reason I don't think we're going to see any solution with regards to the bubble that is the housing market at all in the coming decade, is because housing isn't just housing anymore. It's an investment, and that's made it political. Most families, their biggest asset isn't actually their retirement account. It's the house that they live in. And when house prices go up, people get richer, at least on paper. In reality, that wealth is stuck in housing, and the only real way to access it is to sell and move somewhere completely different where housing is far, far cheaper. We also see that the older you are, the more likely you are to own a home, and the more likely you are to have a lot of equity in your home because you've owned it for a while, you've been paying your mortgage, paying down that principal. And so a large proportion of older people is held in their housing, in housing stock. So if you have housing prices fall, those people get poorer very, very quickly, and they don't like that. They vote against that. We also see this consistent across every single democracy in the world. The older you are, the more likely you are to vote as well. And so governments are basically desperate to prop up housing prices to buy votes, because if you allow the housing market to crash, well, you lose a massive chunk of the voter base and you'll never get re-elected. We've also, of course, got that massive financialization of the housing market. So if house prices do fall drastically or in a quick fashion, we lose lots of the economy with it. We see, realtors and mortgage brokers and bankers and everyone who works on the commission of the size of that market, they're going to make a lot less money too, and that's going to impact the economy. So no matter left or right here, Trump or Biden or Kamala or Vance or whatever it is, and in every country too, America, Canada, the UK, Europe, Australia, the government will always do everything they can to keep house prices as high as possible. And so it is incredibly likely that we're going to see at least modest interest rate cuts to help the housing market, to try and stimulate it and to stop the bubble from popping. Even if inflation goes up, I think interest rates are still likely to be cut. I don't think it's going to be slashed to 0% again. And without that, I don't think it's actually going to have much of an impact on the housing market, because the banks, the bankers, those giving out mortgages are being very cautious, and they're very scared of another repeat global financial crisis like we saw in 2008, where they overlent on subprime properties and there wasn't true value in the housing market and what they were seeing. So that 1% drop that we might see in interest rates over the next year, for instance, it isn't necessarily going to be matched by a 1% drop in mortgage rates, which is exactly what we saw over the last year. Now, the upside of all of this is that inflation is likely going to continue at rates higher than house prices, bare minimum, over the next couple of years, which means that in about half the states around the United States, we're going to see prices come down outright and housing will get more affordable. And in the other half states where housing is still increasing, wages will increase faster than the value of their homes. So again, housing will get more affordable, and that is without a doubt good news. The bad side of this is that our economies, the American economies and every other Western economy as well, is so incredibly influenced and reliant upon high housing prices. Realtors will make less money if there's a housing crash. They'll spend less money. The same will happen for mortgage brokers and home builders and construction workers and bankers and countless other professions as well. And that will all impact the economy and hurt people's wallets.